Hi, good evening, everyone. Welcome to day two of our Budget Unlock 2025. Today, we are going to have an amazing speaker and very enthusiastic and energetic uh, fellow CEO fraternity member, CA Gaurav Singhal, sir. So I hope everyone will be having an amazing and enriching session today. Now, before I hand over to Gaurav Singhal, sir, I would like to introduce his profile, introduce him and let you know about his profile. Mr. Gaurav has an experience of 23 plus years specializing in corporate and international taxation, and he has worked for more than 10 years as part of the tax and regulatory practice of KPMG and ENY. He is a co-founder of Heads Up, a tax boutique firm with offices in Dubai and India. He has advised clients on tax implications both under domestic as well as international tax laws of various transactions, arrangements, remittances, and business proposals. Mr. Gaurav has advised extensively on outbound and inbound investment structures in diverse sectors, entity and jurisdiction structuring, and intermediate holding company formation.
Sujit, I have a suggestion. I know my profile. It is very boring profile, right? My suggestion is, I know a little bit about taxes. I'll try to share that in today's discussion.
Done.
That's my profile.
Thank you so much, sir. Handing over to you, sir. Please proceed. Thank you.
Thank you. Thanks.
Everybody, just sorry to interrupt. Participants, please note that any questions can be posted on the Q&A box, and the chat box also will be open for any open discussions. Thank you, sir. Over to you.
Thank you. Just please confirm. I'm trying to do a screen share right now. Is the screen visible?
Yes, sir. We can see it.
Perfect. Great. So today's discussion is around the provisions of Budget 2025, which affect foreign businesses, non-residents, right? Firstly, my heartiest sort of congratulations to this group for having got together here. There are 98, 99. Okay, now exactly 100 people right now online. And this is commendable that on an evening of a weekday, all of you have got together and you're interested in learning about budget provisions in greater detail in a program which has been created very logically, rather than talking about the whole of the budget in one single go. What you have done is something really commendable. Let's divide it into smallish parts and then focus upon each of these parts. That's what professionalism is supposed to be, and I really recommend that. Thanks. The slide that you see right now here on the screen, that slide is quoting something from the budget speech. This is a verse. This is a quote from a famous Telugu poet. A country is not just its soil, but a country is its people. What we are going to discuss today are those who are, well, outside the country, right? We are talking about non-residents. So today's discussion will be around those changes which are going to affect probably those who are either multinational enterprises. They may be located here, right? Or they may be entirely non-residents, right? So for example, look at even an Indian company which is a part of a multinational group, or for that matter, a foreign entity, which is subjected to transfer pricing adjustment. For that, a really welcome change has been made. That will be the starting point of our conversation. We'll move on from there to pure non-resident service providers who are offered a presumptive regime. We'll talk about why they have been offered this presumptive regime. There's an economic rationale to it. We'll talk about rationalization of LTCG tax rate, which is basically covering some window which had been left open unnecessarily, unintentionally, maybe last year. We'll talk about a lot of changes which have been made for those units which are in Gift City IFSC, a clarification on significant economic presence. We'll talk about virtual digital assets related change, which is basically, well, a reporting mechanism, but naturally it will have an immediate impact on a lot of people who are active in this field, because now their information will be flowing seamlessly to a lot of tax authorities in an automatic exchange of information. We'll talk about some very interesting concept, which is called Global Treasury Center and Regional Treasury Center, GTCs and RTCs. they were facing a particular problem because of a deeming provision in the law, how that problem has been solved. A lot of other, extension of timelines, and finally we'll round it up with some provisions for sovereign wealth fund. Tonnage taxation, I just left it here because, when I was given the brief of what are the topics for my discussion today, it happened to appear there. But since the topic for today's discussion is about non-residents and tonnage taxation is applicable to only an Indian company, I think I'm leaving it for your own reading, right? So that sort of covers it without getting into details of it. I'll keep laughing during the session. My apologies in advance for that. I'm a little bit under the weather. Uh, the first change, and a very interesting change, is around transfer pricing assessment, something which is also called transfer pricing audit worldwide, right? So in India, we call it transfer pricing assessment. Internationally, it is called transfer pricing audit. Right now, the scheme of the transfer pricing is that whenever an assessing officer feels that there's an international transaction which deserves a detailed look, then what does an assessing officer do? In the course of the assessment, he refers the matter to a transfer pricing officer because TPO is a specialist. Now, TPO looks at that international transaction, or if there are multiple ones, then multiple of them. And then he passes a transfer pricing order, TPO order, and that order then is something which the assessing officer applies by passing his assessment order. Now, the thing is that assume you have the same transaction year after year after year, in every year. Then every single year, the matter will get on referred by the AO to the TPO. Every single year, TPO will pass that order. Every single order, the AO will incorporate it. So you see, there's a multiplicity of the proceedings when actually the transactions are nearly same. Well, I know you would say that, Gaurav, in that case, maybe we can go for an APA. Yeah, maybe you can, but APA tends to be a really expensive process. Plus, um, I mean, in India, we have actually used APS quite extensively on even regular transaction, but the intent of the APS was to use it only for very complicated transaction. At least that's how it is still used elsewhere in the world. Therefore, some kind of a resolution was required for this repetitive reference which was being made every single year by the AO to the TPO. And that relaxation is something which has been posed in this budget. So what's the relaxation? The relaxation is that once an AO has referred your case to the TPO for year one, right? The first year, any 1 year. And then the TPO is now passing an order at that stage if you feel that, look, even in the next 2 years, my transfer pricing related transactions, when I'm saying transfer pricing related transaction, it means even the specified domestic transaction, not just the international transaction with related parties, right? If you feel that they're pretty much similar in the next 2 years also, then you can have you have an option. It's your choice. You're the taxpayer, right? You're the assessee. It's your choice that you can tell the transfer pricing officer that, look, sir, I think whatever you have done for this year, because the next couple of years also have similar transactions, nearly identical transactions, then why don't we do one thing? We apply the same outcome as you have arrived upon for this year, year one. So the next 2 years also, year two and year three, immediately next 2 years also. And once the taxpayer exercises this choice, then naturally the TPO is supposed to validate it because the TPO has to see whether the transactions are same, the economic scenario is same, the law has not changed. And once the TPO also comes to the same conclusion that, yeah, what the assessee is saying makes sense, then the TPO will declare that the option exercised by the assessee is valid. And then what the AO will do is that for year one, naturally, he will, in compliance with the order passed by the TPO, make the adjustment in his assessment order. But even for the next 2 years, he will recompute the total income for those next 2 years in accordance with the ALP determined in the first year itself. Right now, this is therefore something which is going to reduce the number of transfer pricing references made by the assessing office to the TPO. Some people are also calling it a mini APA, right? In the sense that APA is applicable for more number of years. This is applicable for lesser number of years. But I think there are multiple differences also with an APA and this option naturally. Also, interestingly, the FAQs which have come out in respect of these budgetary amendments, I've said that, look, it's possible that there are, again, to extend my example, assume in year two, there's a new transaction which comes up, which was not there in year one, right? But that new transaction which has come up in year two is also there in year three. Now, therefore, an assessing officer has a question, or before that, actually, the taxpayer has a question that for year three, I have some transactions which are covered by the TP order of year one, and this one new transaction which is covered by the TP order for year two. Now, can I exercise multiple options for this year three? And the answer to that question is yes, you can. Right? That's interesting. What if for one of the year your case has not even been picked up for scrutiny? Well, firstly, the law, I think, somewhere makes a reference to 143(1), which is an intimation. That means in that case, the AO will make adjustment even to the intimation. The bigger question actually is that maybe if you're getting the timing and your calculation right as an assessee, you should take into account um, whether you'll be at a loss if your case hasn't even been picked up for scrutiny and yet you are going to exercise this option. Therefore, I think personally that you probably exercise this option in only those limited cases where either every single year you are absolutely sure that your case will be picked up for transfer pricing. And when I said limited, I'm not saying limited as such, because I know there are literally thousands of clients for whom the transfer pricing audit is almost guaranteed certainty. So for them, maybe they should look at this alternative, right? Uh, they should also probably examine whether they have a better case in year two and year three. Maybe because of the change in the comparables margins, maybe because of the change in the economic scenario, and probably therefore they are better off fighting in those two cases, in those 2 years, year two and year three, anyway and separately without getting covered by year one, because probably in year two and year three, they will come out with a lower transfer pricing adjustment or maybe no transfer pricing adjustment, right? So therefore, this is a choice which has been left to the assessee. The assessee is supposed to exercise this choice. Um, of course, that one question which has also come up is that just by exercising this option for year two and year three, are we saying that the assessee is in a sense of speaking, conceding that the adjustment made for year one is correct either in the context of year one or at least in the context of year two and year three, and therefore is the assessee giving up his right to dispute those adjustment, to object to those assessments before the DRP or frankly even CIT appeal? Uh, in my personal reading, I don't think so, because there is nowhere in this provision which says that once you have exercised this option, then you cannot go in further appeal. Because assessing officer is still going to pass an order yet, and the assessing officer is still going to make an adjustment to the arm's length, to the transaction value of the international transaction or the specified domestic transaction, and therefore, I think in my reading, I might be wrong, that you will have an option to object or to appeal against the outcome for year two and year three as well. But of course, a finer reading and more detailed rules will probably help this greater. Why I'm talking about this more detailed rule is because this provision clearly makes a reference to a power granted to the cell government that will come out with more detailed rules to sort of explain the nuances, the procedural aspect of how this option will work. So a lot more is expected to be sort of clarified in respect of this amendment. But I would say this is a welcome change. If at all, I mean, even if you think that if it's of no use to you, no worries, don't exercise it. But I'm sure a lot of people will probably find it useful. Moving on to the next change. Now, this next change actually has a history. I'm sure you would remember that a few years back when we were all kind of locked up in our homes, working entirely using the likes of Zoom, Teams, Google Meets, and likes. At that time, if you recall, there was a particular stage at which there was a lot of buzz that the prices of laptops, right, has gone up. And in fact, the availability has gone down, tremendously, right? Now, um, a lot of reasons were there, but most importantly, it was very clear that we were heavily relying upon imports of laptops, of semiconductors, of display screens, right? And at that stage, also the government realized that when we are trying to be Atmanirbhar about a lot of things, we should perhaps be Atmanirbhar about this also. And somewhere towards the end of 2021, this initiative of Semicon India was launched by Ministry of Information and Technology, something which is abbreviated as MITI, right? Somewhere in 2024, it was modified by the government. But the idea is to encourage, to give an impetus to the manufacturing of semiconductors, their development, and that of display manufacturing systems, right? Because the idea is to try and be Atmanirbhar in these fields. Yeah. So one of the things which has happened in this year in the budget is that to sort of incentivize, question comes up is that a lot of times you require the help of certain experts, and that expertise is not presently there in the country. That could be with foreign businesses, foreign suppliers, right? So, in order to incentivize those foreign businesses to help us set up the facilities for semiconductor development and facilities for display of manufacturing systems in India, we are actually incentivizing this time the non-resident service providers who will help the Indian companies. I mean, I'm saying Indian resident companies who will be setting up or operating these semiconductor and display manufacturing units, right? So the idea is therefore not just to encourage the manufacturers themselves who have got encouragements. If you go through the Mighty scheme, which is already there online, you'll find it, right? If you look for Semicon India, but to also encourage the non-resident service providers who are helping in setting up of this electronics manufacturing facility, or those who are helping in connection with manufacturing and producing of these kinds of electronic goods. I repeat, it's not just any electronic, it's only those electronics which are covered by this sort of, mighty scheme that I'm referring to, MEITY scheme that I'm referring to. This so what kind of income streams of these non-resident service providers are we talking about? Firstly, these are non-resident service providers who are either supplying services to these Indian businesses or to those resident companies which are setting up or operating these manufacturing facilities here. So service providers will be earning service income. It could be fees for management services, it could be fees for technical services, it could be fees for consulting services. It could be a more refined version, which is fees for included services. It could be remuneration for technology, right? So I think technology, to my mind at least, I think that we are probably also talking about royalty. Again, if you look at the FAQs which have come alongside these, they've also covered supply of technical personnel, right? Provision of technical personnel. So again, non-resident service provider who are sending to India technical personnel to help those Indian resident companies who are, setting up or operating these electronic goods manufacturing facilities. Again, any payment which will be made to even these non-resident suppliers of technical personnel, all of these payments at a gross level, rather than asking them that prove what is your net income. No, at a gross level, 25% of these gross receipts will be deemed to be their taxable income. Well, technically, their profits and gains from business and profession, right? So that means, and then because they are foreign companies, they're in all probability going to be foreign companies. They'll be subjected to a 35% rate of tax on this 25% deemed income. If you run the numbers, it works out to around 9%, certainly less than 10% effective tax rate. So it is even lesser than the rate of royalty and FTS taxation in most of the treaty, and certainly less than half the rate which is given in the domestic tax law. I'm referring to section 115A. Yeah. So therefore, the non-residents will have an easy day in the sense that they don't have to prove to anybody, even if they end up creating a permanent establishment here. These deeming provisions, they still create an exception, and they say that still doesn't matter. Don't bother about proving to us what are your expenses, what are your depreciation allowances, all of those things, out of the window. Instead, just tell us what's your gross income. And on that gross income, we'll give you this presumptive taxation regime. That means effectively 9% rate of tax on your gross receipts. Now, mind you, this is the provision in the domestic tax law. This provision has not actually overruled the treaty. Why I'm specifically pointing this out is because suppose this non-resident service provider is located in a country, the treaty of which contains a provision which is even more beneficial than this presumptive tax rate provision, which could be, say, because I'm just giving an example here, that the provision in the treaty contains either a rate which is even lesser than 9%. Some treaties have, I think, 7.5% rate here and there. And more importantly, assume there are treaties which have a definition of FTS or FIS, which contains that make available clause. I'm sure you're aware of that, which means that in some cases, those services and their remuneration will not be taxable in India unless they satisfy some condition. In that case, if they do not satisfy those conditions, that means those services and their remuneration are not taxable in India. In that case, probably those non-residents will be better off applying those treaty provisions. So the treaty provisions still exist if they are more beneficial, even than this presumptive tax rate. The non-residents are at a liberty to make a choice in favor of those treaty provisions. Okay, so moving on to the third. I'm just quickly checking, are there any questions? In the chat box, I don't see any questions at all. Okay, so moving on. I'm now looking at the provisions which have been actually brought in just because a little bit of gap had been left in last year. Last year, when the Finance Number 2 Act 2024 came out, it actually increased the rate of LTCG for resident as well as non-residents to 12.5%. It's from 10%, right? But interestingly, FIIs, when they were earning those LTCGs, which are not covered by 112A, right? Because not listed securities, right? But those which are covered by 112, that means unlisted securities, non-convertible debentures, right? GSECs, right? All of those, for that, no change was made last year. As a result, there was an inequality that got created. So while everybody, including the FIIs, were getting taxed at the rate of 12.5% for all capital gains, there was one exception that FIIs were getting taxed at the rate of 10% for capital gains earned on unlisted securities. Now that gap has been plugged in this year, not even from retrospective effect. That gap has been plugged in this year. So now they will also pay a 12.5% long-term capital gain tax on gains from unlisted securities, zero coupon bonds, and NCDs, and such likes, right? Sorry. A lot of places in a lot of places in the finance bill, you'll see the references to IFSCs. A lot of small changes have been made here and there. One of these changes that we are looking at right now is that presently the law says under Section 10 that whenever any income is earned by a non-resident from offshore banking unit in IFSC, right, from certain kinds of transactions such as sale of non-deliverable forward contracts, offshore derivative instruments, OTC derivatives, right, then that is exempt by virtue of Section 10. Now that same benefit has been extended even if the non-resident is deriving similar income from similar instruments, but this time not from offshore banking unit, but from foreign portfolio investors that are located in IFSC. We already know the definition of foreign portfolio investor. No change has been made therein. Same reference to SEBI. I repeat, please don't think that the foreign portfolio investors have been exempted. No. Income of the non-residents who are deriving this kind of income from FPIs located in IFSC, that income, gentlemen, ladies, that income has been extended, has been exempted. Okay, so let's talk about significant economic presence. I know this is a topic, which creates a lot of buzz and a fair degree of controversy. In the domestic tax law of India, we have already had this concept called business connection. This was nearly a similar but not identical concept permanent establishments in the tax treaties, right? Now, OECD in its BEPS Action Plan 1 said that, look, we have to do something about taxation of a lot of digital businesses. And it discussed about multiple possible, solutions to that. It discussed about equalization levi. India implemented it. It discussed about significant economic presence. India implemented that too. Right? How did we implement significant economic presence? We introduced the concept of significant economic presence in the domestic tax law. Where did we implement it? Where did we bring it? We included significant economic presence in the definition of business connection. So what happens? Let me sort of quickly revise. Uh, Section 9 tells us which income is deemed to accrue or arise in India, and therefore taxable in India in respect of non-residents. Now, if a non-resident has a business connection in India, then that income which is attributable to operations carried out in India is taxable in India by virtue of this Section 9. Now, since business connection attributed income is income attributed to business connection is taxable in India, uh, when we extended the definition of business connection to include even significant economic presence, and there's a definition of significant economic presence, I'm sure you know the controversy, right? You know the nuances of it. So then naturally it means that now any income which is attributable to even an SEP will be now taxable in India, at least under the domestic tax law, right? Now, the thing here is that the way SEP as a concept is defined, it focuses more upon transaction, it focuses more upon activities like solicitation, right? As against the broader concept of business connection, which talks about operations. This is important, right? I repeat, business connection, operations, SEP, transactions and activities, right? So business connection sort of is sort of created based upon the nature of operations carried out in India by a non-resident, whereas an SCP gets created by virtue of certain kinds of transaction and activities, and technically sometimes those transaction and activities are not even carried out in India, right? They're just there. Now, classically itself, the definition of business connection created an exception, contain an exception, that even if a non-resident can be said to have met all the tests of a business connection in India, still we will not tax him if the non-residents operations in India are confined only to purchase of goods in India for the purpose of export outside India. Now, this was something which was there so as to basically encourage the non-residents to carry out purchasing in India and then directly exporting them out of India, right? So this was basically, purchasing or exporting, incentive. I repeat, this benefit was there in the context of operations carried out in India. Operations, again, remember, this is the word which I just not told you is there in the classical definition of business connection. But then the problem is SCP doesn't get triggered because of operations in India. It can get triggered even if there are no operations in India. Instead, there are only certain specific kinds of transaction and activities, right? Now, the problem was therefore that if there are those transaction and activities, no operations in India, but there are certain transactions and activities which are confined again to purchase of goods in India for export. Would that mean that the non-resident can have an SEP in India? And that was the nebulous, that was the ambiguity which was left open, right? Now, therefore, to bring it at par, that since operations confined to purchasing of goods for export cannot create business connections, similarly, transaction or activities, okay, which are confined to purchase of goods for export cannot create SCP. So, in a sense of speaking, they've been brought at par. Pure purchasing by a non-resident in India of goods for the purpose of export outside India will not create a significant economic presence, right? That does not necessarily mean that you have to read between the lines one way or another, right? That is, that therefore, if you're purchasing goods, but you're not exporting them, then that will definitely create a significant economic presence. On that, the view is still out. A lot of litigation is going to happen on this, particularly in the context of those non-residents who are either coming through a non-treaty country, or they are not choosing to or unable to furnish a TRC to their Indian business associates, right? I'm moving on to virtual digit. This is something which came in relation to crypto assets. Again, this also has a bit of a history. OECD somewhere around 2022, they felt that, look, a lot of these transactions in relation to crypto are getting, we are unable to sort of, track it all. Even if we have the technical capability to. I mean, there are a lot of transactions which are happening. There should be some framework, some reporting framework, by virtue of which service providers in the category of cryptos should be required to report to their respective domestic tax authorities, which in turn will then carry out an automatic exchange of information worldwide, right? So, therefore, a crypto asset reporting framework was created somewhere around 2022. And at that time, therefore, the idea was that all those jurisdictions which are covered in this thing, there are 52 jurisdictions, right? In the second bullet, you can see the word ACRF. It is not ACRF. It is, again, crypto assets reporting framework, CARF. It's a typo at mine. Apologies. So these relevant jurisdictions, they then decided that we will now undertake automatic exchange of tax relevant information on crypto assets. And the implementation of this framework was called in the New Delhi Declaration of G20 leaders. Yeah. So now, therefore, India said that, look, we should take this step. And therefore, while in 2022 itself, we introduced a provision for taxation of BDAs, which includes crypto, we didn't introduce any such framework back then. Now, it is decided to introduce this framework, right? So the first thing that we did was, there was a definition of crypto assets which was agreed upon in that CARF of the OECD, right? Actually, the definition of CARF is supposed to be very wide, all-encompassing. It's supposed to cover, meme coins. It's supposed to cover stable coins. It's supposed to cover non-fungible tokens, everything, right? But we already had in Indian tax law a definition of virtual digital assets. Now we have two definitions. So what did we do in order to bring it at par? The definition which is there in the CARF, sorry, is now also incorporated in the definition in the domestic tax law of virtual digital assets. So that's the first change. So as to make sure that all crypto assets are now covered by this framework, as well as the taxing provisions, right? Second change which has been made, and that's a new thing, that now all the crypto asset service providers, that is CASPs, for example, exchanges, right? Crypto exchanges. All of these people will be required to furnish certain information to the tax authorities, right? What kind of information are we talking about? We are talking about, or what kind of, what these CASPs that we're talking about? There's a definition of CASPs that any individual or entity that's a business provider or service provider to effectuate the transactions in crypto assets, and what kind of information are they required to furnish? Firstly, personal information related to user, that means its tax residence and its taxpayer information, identification number, TIN. And three types of transactions. Firstly, when you use a fiat currency, that is the normal currency. Fiat currency is like the normal currency, rupees, dollars, right? When you use the fiat currency to buy a crypto, such as an NFT, or for that matter, even a Bitcoin, or vice versa. When you sell it and finally exit it, you monetize it, you get the money back. That is an exchange between crypto asset and fiat currency. That is required to be reported by CASPs. Secondly, when you flip from one crypto to another, right? You're holding on to USDTs, and now you buy a Bitcoin or an Ether. Then that's exchange between one or more forms of crypto assets. That's required to be reported. Even if you transfer any of these to an unhosted wallet, right? Still, even that is required to be reported by the CASPs to the tax authorities. So basically, you will find that the idea is to plug all possible ways through which people will try to use the sort of shield of opacity around crypto transactions. We are now looking at the next change. This change is in respect of a particular activity, which is something which foreign companies are sort of encouraged, or multinational enterprises are encouraged to carry out in the Indian gift city, in the Indian International Financial Services Center, IFSCs. Which activity I'm talking about? I'm talking about global or regional treasury centers. Now, what do I mean by treasury centers here? So basically, what I'm saying is, that there is a multinational enterprise which has presence in multiple countries. It sets up a presence in the gift city, and that presence in the gift city that manages the treasury function. As a result of which, it borrows from some group companies, it lends to other group companies depending upon who has excess liquidity and who needs liquidity. Now, this is all good, but there's one problem. And that problem is the provisions of deemed dividend, section 2, subsection 22 of the income tax law, which say that, look, whenever companies borrow, from each other, between related parties, even such borrowing will be deemed to be taxable as dividend under section 2, subsection 22, specifically clause B. Now, while there is a relaxation in respect of companies that are listed in India, there is no similar relaxation in respect of companies that are listed outside India. Now, if you meet these twin conditions, this relaxation is now available to you. Condition number one, that A, you should be set up as a GTC or an RTC, a global or a regional treasury center in IFSC in India. And second condition, both of these are to be fulfilled, that your parent entity or principal entity is listed on a stock exchange outside India. Both these conditions are met. In that case, this treasury center, even if it will borrow, still that borrowing will not be taxed as dividend in its hands. There are certain deadlines which were there in respect of IFSC units, which have been extended from 2025 to 2030. For example, firstly, the most important one, ATLA, which gives a deduction to all the IFSC units in respect of their incomes. Section 10, subsection 4D, which talks about transfer of assets. 4F, this particularly is about those units which are engaged in the leasing of aircrafts. Now, shipping is also included in a lot of sections. When those units would earn royalty income or interest income, right? That income is exempt. Similarly, when those units, when they have invested into the shares of similar such units also in IFSC, right? So there are two IFSC units, both of them are engaged in the business of leasing of aircrafts and now also shipping. And one unit has invested into the capital of the other. Then the income by way of capital gains, which the first unit will earn if it sells the shares in the second unit, that is also exempted. Again, with the extended timelines of 2030, similar provision is there for dividend income also. As I mentioned, in past, a lot of these benefits were given only to those units that were into aviation leasing, but not the ones which were into shipping leasing. Now that has also been allowed. That means a lot of these benefits will now be available to those units which are into ship leasing. Now we're talking about the provisions which are there for sovereign wealth funds and pension funds. And there's one particular Abu Dhabi investment fund also. Yeah. See, essentially, first of all, let's understand what are these funds that we're talking about. Imagine the government of a country which has a budget surplus, right? Not a budget deficit, but a budget surplus. Now, it has excess money. What would it do with its excess money? Will it keep it in the money form? Obviously not, right? That's the most unproductive asset. So obviously it would like to invest it. Now, imagine a sovereign, it creates a fund like a sovereign wealth fund. And now it makes investments out of that sovereign wealth fund. Actually, it's a concept which was, I think, first discussed I mean, this exact expression was used somewhere in 2005, but the concept has been in existence for quite some time. It was there actually in US states also. The Texas state created in US such fund for investing in education, right? So the idea basically is that these funds are the ones who are going to invest in those sectors where a normal investor will probably not invest because it is a very long-term tenure, right? Now, naturally, what we are therefore saying is that these kind of decision making is also take a lot of time. Now, already there exists a provision which says that for the sovereign wealth funds and similar kinds of funds, including pension funds, their income, what would be their income? They would invest in securities. They would invest in typically, they have earned from commodities, but they invest in, comparatively risky securities. So they would invest, and therefore they will earn either dividend income or interest income, or they will sell and they'll earn capital gains. Yeah. So all of that income is already exempt. But the condition was that the investment should have been made by March 2025. But now we already know that these things take time. Therefore, this timeline has also been extended to 2030. There was one, strange, result which had arisen from an amendment which was made in past. Sometime back, we introduced a section called 50AA. That section says that in respect of market-linked debentures and a few such similar securities, even if you are selling them after holding them on for a long term, very long term, still the gain will always be short-term capital, right? Now, because of this deeming fiction, the problem is that Section 10 says that we'll give you the exemption only for long-term capital, right? Whereas 50AA says no, it's a short-term capital. Now, that problem has been bridged by saying fine, even if a gain is deemed to be short-term capital gain by virtue of this Section 50AA, still, if you have exited after long term, we will give the exemption of Section 10 in respect of this income as well. I think we have now come almost to the end of today's discussion. As I mentioned, this provision is actually not about non-residents. This provision is basically about Indian companies, right? This is one of the conditions, right, that are owning a ship. They were given a beneficial provision. I think 115 BG is that section which says that your income will be computed with reference to your tonnage carrying capacity. Yeah. But that benefit was there only if you're carrying, in international waterways, right? Now that same benefit is provided to you, even if you are owning an inland vessel and therefore you're operating it in the inland transport. You will therefore find that multiple places in the chapter related to tonnage taxation, this amendment has been made. And at all those places, wherever we were only talking about foreign going shipping vessels, we are now also talking about an inland vessel.
Thank you so much, sir, for the very enlightening and very elaborate discussion on the topics that are given in the budget. I hope to see you soon again in the coming sessions. And most importantly, thank you for taking time, even though you're having fever and cough, and that is so commendable. And thank you for making you trouble at this time.
Don't worry about it. Don't worry about it at all. It's entirely my pleasure. It's entirely my pleasure. It's lovely having an opportunity to interact with all the spirited people. I completely loved it. Thank you so much. Thanks a lot.
Thank you, Gaurav. Thank you so much. Bye.
Thank you. Thanks. Thank you.